So there's been a lot of commentary around interest rates, or what's known as the cash rate here in Australia. So I wanted to take a look back on the data we have on interest rates and see just how these latest interest rate hikes compare to previous years and whether we are at a normal level in terms of where they have been in the past. To start off, I want to explain as best I can what the cash rate is and what is its purpose. So this is straight from the Reserve Bank of Australia's website, and it states, the cash rate is the interest rate on unsecured overnight loans between banks. It is the near risk-free benchmark rate for the Australian dollar. So the cash rate in Australia is the interest rate set by the Reserve Bank of Australia. It represents the rate at which banks borrow and lend funds among themselves overnight. This rate plays a crucial role in influencing the overall interest rates in the Australian economy, including those on loans and saving accounts. It's a key tool used by the RBA to manage monetary policy, control inflation, stimulate economic growth, or cool down an overheated economy. So when consumer spending or inflation is high, the Reserve Bank will start to raise the cash rate to slow or control people's spending. And when consumer spending or inflation is low, they will lower the cash rate, which will encourage people to go out and spend money in the economy. Then we have economic factors like a financial crisis, where depending on the situation, they will increase or decrease the cash rate to help the economic situation. So I wanted to jump in and have a look at the actual data and get a bit of a snapshot on interest rates and these latest rises and see where they stack up in terms of past years. If we jump in and have a look now, we can see that the cash rate in 1990 started at 17.5%, and in the space of 3 years it went from 17.5 to 4.75%, and then back up in 1995 to 7.5. So in the space of 1 year, it's gone from 4.75. Yeah, so in the space of 1 year, it went from 4.75 to 7.5. And on average, it looks like the cash rate is sitting around the 5% mark. You see the 5% mark on the left here, and you can see that the majority of the rates have been sitting around that 5%. And as you see in 2008, when the financial crisis was here, it went from 7.25% and dropped to 3%, and then slowly went back up to 4.75% in 2011. And from 2011, 2012, we've seen a pretty long gradual decline from 4.75 all the way to 3rd of June 2020, or you can even go to 5th of May 2021. It drops down from 4.75 to 0.10%. So from the start of 2020 till June 2022, we've seen the cash rate pretty much on or below zero. and then we went from 0.10% in the space of 12 months. We've gone right up to the 4.1% that we're now sitting at. So yes, it is a a sharp rise, but it is very similar to the rise in 1994 to 1995, where it went from 4.75 to 7.5. Very, very similar. And now we're at the 4.1%, which if you take a look and take a step back and look at the whole picture of the cash rate here, you can see that 4.1 is really at a normal level in terms of the history of the cash rate or the history of the interest rates. 4.1% is at a normal level. So super important to, if you do buy a house, having that knowledge that 4.1% or around the 5%, just to be conservative, knowing that and buying a property, knowing that the normal rate is 4% and buying a property to be in level with that 4% and your mortgage repayments at that 4%, 5% is super important. So that's very important not to be over leveraged on your property. And I do want to have a look in now the CoreLogic data, which is just incredible. Shout out to CoreLogic for all this amazing information where it shows not only the interest rates and how they've gone up and down, but it also shows you the value of property. So I want to have a look and see if interest rates rising coincide with house prices declining, because we see a lot on the media saying high interest rates, property is going to drop. So let's just have a look and see what the data says. So as we can go back from the start, 1990, it was at 17%. And it slowly dropped from 17% to, I don't know, it went to like 4% in 1994 and then went back up in 97, 98. And as you can see here, house prices definitely didn't decline as interest rates dropped, and they didn't go up either. It wasn't until around the 2000s we started to see a pretty sharp increase in house values. And what was the interest rates? So from this time, it says here on the data from CoreLogic, it says mortgage rates gradually rise from 6.1% in April of 2002 to 9.6% in August of 2008. And within those 6 years, house prices continued to grow. So it did not affect house prices at all in between that period. And then if we continue on past 2008, we see the GFC, and it says here, GFC, Australian housing values fall 7.5% over the 2008 calendar year. US values down 17%, UK down 11%, and New Zealand was down 8% in house prices. So within that year, house prices only fell 7.5% during that major economic downturn. And it also says we had a resources boom. Commodity prices climbed to 215% between 2004 and 2011. So that gives us a clear indication to how we got through that GFC is because we had those resources and we had those commodities to get us through that major downturn from the GFC. Going past the GFC, we look at, so October of 2009, RBA commences interest rate tightening, lifting the cash rate from 3% to 4.75% in December 2010. So within a year, it went from 3% to 4.75%. And within that year, we've seen house prices continue to grow. And from 2012 to 2020, we've seen just major growth in house prices, some of the biggest growth we've ever seen. And then we had the COVID pandemic declared, and it says Sydney and Melbourne housing values peak after rising 72% and 56% over the past 5 years. So that shows that Sydney and Melbourne houses increased in value. And then we've seen the downturn of the pandemic, and we've seen, okay, so from the pandemic, we've seen interest rates rise sharply, and we've seen house prices pretty much coincide with those rises in interest rates. Well, anyway, I hope that video gives you some insight. It's just a bit of an understanding that where we are now in terms of the cash rate or the interest rate at 4.1%, just make sure you understand that that really is the normal level at 4.1 to 5%. And another thing to think about is when the media go on about how rising interest rates are gonna drop house prices, looking here at the data, it shows that as interest rates rise, so does house prices pretty much coincide with rising house prices and rising interest rates. So it's good to look at the data, and I hope this wasn't too much of a blabber on, but anyway, I'll let you get going and I will see you on the next one. Peace.